The internet will start with 5 million IP users, and there will be 5 million crypto wallets. We saw the internet grow at 76% a year for 8 years, then slow down to 43% a year after that. It was the world's fastest acceptance of technology ever. Crypto has been rising at a rate of 137% per year. It now has 516 million users, up from 187 million on the internet at the same point. In the end, we thought that crypto would just grow more slowly, like the internet. That's not likely to happen. It seems like it would go faster. But by the end of 2025, we'll have 1.1 billion people. That's twice as fast as the internet grew. On May 5th, which was a big day for the most popular coin, a website that keeps track of Bitcoin transactions, Clark Moody, posted about this accomplishment on social media. It happened exactly 15 years, 4 months, and 4 days after the first Bitcoin block was mined on January 3, 2009. Raoul, a famous macroanalyst and former executive at Goldman Sachs, says that the Bitcoin industry will reach another important milestone in 2024. He said that even though the price of crypto has been going down lately, it is still being adopted at twice the speed of the internet and will have about 1 billion users by the end of 2025. Willy Woo, an independent Bitcoin expert, said similar things. He said that the industry is on track to have 1 billion users by the end of 2025. Binance data that shows 65% of crypto users hold Bitcoin backs up Woo's claims. There is general agreement that this level of adoption will soon be reached, though some experts think it might take longer than that, maybe reaching 1 billion users by 2030. All digital goods are likely to become much more valuable as a result of this growth. Powell recently talked about macroeconomic conditions and how they affect the cryptocurrency market in a video on his Real Vision platform. This added to the positive view for crypto's future use and value. Growth. Let's talk about these 3 things. First, let's look at how productive people are. As the workforce ages, productivity has been going down over time. This makes the growth rate of GDP go down. On the other hand, debt has been growing. But what we find is that the growth of family debt stopped in 2008 because banks stopped giving people loans. It's just harder to get into debt. Companies have also been paying off debt, so their growth hasn't been as fast as GDP. However, as we all know, the central banks are now driving a lot of the growth in debt. The US has huge debts right now and is paying for them by taking out even more debt. The return on investments, inflation, and everything else in the world are all driven by demographics. This is the most important thing on this page. Here's the trend rate of growth for the people aged 15 to 64 who are able to work. As people age, it has been going down over time. Those people don't get things done. It gets harder to get things done as you age. During their early years, they took out loans which are now paid off. That makes a lot of sense. I've talked a lot about this on Real Vision before. We can also look ahead though. And if you remember my piece about the retirement problem, I've been showing this chart for a while now. It shows the rate of people working compared to the rate of births and deaths. I'm sorry, this is the birth rate 14 years from now. It's also clear that the birth rate affects the number of people jobs over time. It also says that the number of people working should keep going down over time. People who used to only work part-time have started working full-time again because they don't have enough money. We'll see some of that too. But over time, the labor force participation rate will go down because fewer people are entering the job than are leaving it. This is what makes businesses slow down. It started in Japan and is now spreading to China, South Korea, Taiwan, and most of Europe. Anyway, that's the big trend. This big trend is different in some ways. People keep telling me that demographics is the most important thing, and when you take everything else out, you see that the US government debt as a percent of GDP is exactly the same as the labor force participation rate. It says that the economy slows down when fewer people are working, but there are all those benefits for older people that need to be paid for. The government owes more money. That link is amazing, and that chart is a great way to understand the world we live in now and why governments keep taking on debt and then have to print money to fix the problem. It all has to do with numbers. In other words, they add money to the system by taking on debt. That's the falling value of money I talked about. You can also see the link between FedNet cash and the amount of debt the US government has as a share of GDP. They're pretty much the same. The scale is different, but the trend is still the same. In other words, they're debasing the currency to get cash to pay for the rise in debt. It is known as financial repression. Another shocking thing we found in the Everything Code that is actually how things work is that most of the increase in government debt is just interest on bills that are already there. They aren't really taking out a lot more loans to put money into the market. It's mostly paying off old bills. Because of this, there is a strong link between the interest payments from the last cycle and the cash flow for this cycle. They took out new debt, it's time to renew it, and they've already been taking out new debt this cycle. To pay for the interest payments from the last cycle, they are adding more money to the system. Take a look at that curve. That's what we think will happen here, driven by the interest payments on the huge amount of debt that was caused by the pandemic. With interest payments on top of interest payments on top of interest payments, it's clear that this debt keeps growing. This isn't how I think it will all play out, but I do think there will be a lot more cash in the future. And that's a key part of the idea. Take a look at that direction of total liquidity. Imagine it in a different setting. That is the trend of coins losing value over time. That debasing the currency makes it look like the prices of assets are going up. This graph of the Nasdaq vs. the total liquidity measure shows how closely they are linked. In fact, there is a 97.5% connection. Since this is a secular trend, the Nasdaq actually does better than this. However, this debasement explains almost all of the moves of all assets over time, which is why everything is so linked. Things do move forward and backward, but this is the most important picture to understand. That question has an answer: more debt. The economy is slowing down because of changes in population, so to make up for it, they print more money and lower the value of the currency. That makes the prices of things go up. It's very important that you remember this secret. This is the index of global liquidity that all the big central banks have put together. It's growing at a rate of 8% per year. The risk of any investment goes up by 12% when you add in world inflation, which we'll call 4% for now. That's pretty amazing since the S&P 500 only goes up about 12% a year. In a sense, you're not getting ahead by doing it. Your savings won't earn future value, they will only earn present value. People have a lot of trouble with this 12% hurdle rate if they don't understand it. If you don't hit your 12%, you're mostly getting poorer. For example, if you only buy bonds because you think the 5% interest is a good deal, you will end up worse off in the long run. When I talk about crypto, I use Bitcoin as an example since it has been in value the longest. It too has an amazing link to world liquidity. While Bitcoin does have a strong 87.5% correlation with the Nasdaq, this isn't as high as it could be because, as you can see, the correlation is lower during times of high performance, like when cryptomania hits. This is because Bitcoin's curve is much more exponential because it's driven by tech adoption. We'll also talk about that in a moment. You can see, though, that Bitcoin Plus is driven by liquidity. If I compare Bitcoin to world liquidity, though, it does 105% better each year than the debasement. I mean, that's a huge difference from world stocks, which aren't doing anything and are probably going down. Being able to buy things in the future will be very different because of that. This is a very important